So you're thinking about buying your first house, right? All right, and if you stick around to the end of the video, I'll tell you how this conversation or how this usually goes. But before you go looking willy-nilly through house listings and whatnot, buying your first home, you really should ask yourself 3 questions. And the first question is, do you have 3 to 6 months of after-tax income saved up? Because if you don't, well, then you're not really ready at all to be looking at houses. You should have your financial ducks in a row. You should have 3 to 6 months of your after-tax income saved up before you go buying your house. We'll get into a little bit more on why later, but houses are expensive. There's all kinds of crap that goes along with it. And there's always surprises, always stuff that you should have thought of. All right, number 2. Have you checked your FICO score recently? I did a video about FICO scores and what they mean and how to make sense of all that stuff. If you have checked your FICO score recently, well, great. If you have not, well, then you've got one of the first things that you need to be doing right there. If you've checked your FICO score, then is it above or below 670? If it's below 670, then you are not ready, my friend, to be buying a house right now. You've still got some more work to do before you purchase your home. If your FICO score is above 670, then you might be in okay shape. The next question to ask, so this has kind of been 2A and 2B, the secondary question you need to ask is, are you close to the next level? If you're in the good range, are you close to very good? If you're very good, are you close to excellent? Okay? Because if you are, it would be better for you to wait until you get to that higher level before you go seeking finance on your home and everything else, because remember, lenders are gamblers, and the higher your FICO score, the less risk you present to them. So, of course, the higher your FICO score, the better an interest rate you're going to get on your mortgage. Okay? And now we move on to the big question, the giant question, the third question, which really is the most vital question. If you're thinking about considering purchasing your very first home. And that question is, how much of a house payment can you really afford? And the reason I ask this is because I've mentioned before as well that you should know that your housing costs should only be 1/3 of your net income. However, just because you were able to afford $1,000 a month mortgage rent on an apartment does not mean you'll be able to afford $1,000 a month house payment. And here's why. I'll explain. So when you're purchasing your first house, there's a lot that you have to factor in, okay? You're not just worried about principal and interest on your house. There's a bunch of other things that are going to come in to complicate the situation. First and foremost, you have to factor in property taxes on the house that you're buying, because those have to be paid every year, and homeowners insurance, because that has to be paid every year. And homeowners insurance is way, way more expensive than renter's insurance. They're not just guaranteeing the value of your stuff, they're guaranteeing the value of your home. So that's going to increase significantly, okay? Now, a lot of these things tend to be, all of this tends to be factored into escrow, okay, which factors into your mortgage payment. So your mortgage payment is typically principal, interest, and escrow. Unless you've got more than 20% to put down on your home, have taken out a conventional loan, blah, blah, blah. If you have not done that, then of course there's also the possibility of you paying PMI, which is very evil. I'll get into it in another video probably, but sadly, if you don't have 20% to put down on your home, you most likely will not be able to avoid paying PMI. If you can, great, but usually there's some catch or gotcha. The other thing that you might have to consider is some sort of homeowners association fees. Those are popping up more and more and more. And all this goes into considering your housing costs. But wait, there's still more. Have you taken into consideration, have you factored in that your utility costs that you're responsible for are probably going to go up? Things that might have been included in your rent before are now going to be your problem. Things like garbage, things like recycling, things like sewer bills. You're now going to have higher electric bills probably. You're most likely going to have a higher water bill. All these things factor into home ownership costs and should be factored into your budget before you go looking for your first house. You also have to consider that there's now going to be a yard to maintain. Maintenance on the entire place is going to be your problem. Garbage disposal goes out, you can't call maintenance anymore. Nope. You got to take care of that yourself. You're either calling a plumber, paying $300 to $400, or taking care of it yourself and paying $200. You got to decide. Okay? So you want to factor these things in before you go shopping for your very first house. And just as a final note, there's a couple of other little nuances that come into play. Number one, you're most likely going to have increased travel expenses back and forth to work, school, whatever, for your new house. You're also going to want to fill that house up with furniture. That's right. So if you don't have money saved up, if you're not prepared for that nifty little expense, then that might be something you want to consider before you go just shopping willy-nilly. Now, I told you at the beginning I'd get into how this conversation usually goes. Usually what happens is somebody goes, you know what, I'm sick of paying rent each month. I'd rather have a house. Or, oh, we've got a kid on the way. We need to get a house. Oh, I'm sick of car repairs and not being able to work on my own car. I need to get a house that's got a garage so that I can work on my own car. All those things usually come up, and then boom, instantly start hitting the listings and whatnot. Then go out and get pre-qualified for a mortgage, and of course, the banks and mortgage companies, credit unions, they just want to get you in a home so they can start making money off of interest off of you, right? That's their main goal. They don't care. They only care to a certain extent whether you've got a little bit of savings and what your debt-to-income ratio is. Beyond that, whether or not you can really and truly afford that new mortgage that you're going to be taking on and responsible for, they don't give a rat's ass. So please, look into these things yourself. I'm going to talk more about it because it's a popular subject and there's a lot more that can be said. But if you have questions, leave them in the comments below the video. If you're watching this on YouTube, if you're on Twitch or Xbox, you can message me. If you would rather email me, you could send that to me at fustianfinance@gmail.com.